You're not broke. The economy isn't collapsing, and yet something feels wrong. Prices aren't falling, savings don't feel safe, and financial stress keeps rising, even when headlines say things are stable. What if the real danger isn't a crash, but a slow crisis building quietly, right now, that hits wallets in 2026? This isn't speculation, it's not social media panic, and it's not obvious yet. But once it shows up, it's already too late. This is Economic Global Brief. Here's the hidden crisis most people aren't watching. Right now, the global economy looks calm on the surface. Inflation is lower than its peak. Interest rates are no longer rising aggressively. Markets are not crashing. But this normal is misleading. According to data from the IMF, OECD, and World Bank, growth in the US and UK is slowing, not strengthening. Households are still spending, not because they're confident, but because they're stretching. Credit cards, buy now, pay later, delayed savings. The system looks stable because people are absorbing the pressure themselves. That pressure doesn't disappear, it accumulates. This is where the real danger begins. Household debt in the US and UK is near record levels. Government debt is already historic. But here's the key problem. Debt worked when interest rates were near zero. It doesn't work the same way anymore. Even if rates fall slightly in 2026, they are unlikely to return to ultra-low levels. That means higher refinancing costs, slower consumer spending, governments with less room to respond to shocks. This creates debt fatigue, where borrowers can no longer roll problems forward. Not a crash, a grind. Many people are waiting for prices to go back. That's not how modern inflation works. Central banks have made this clear. They aim to slow inflation, not reverse prices. Once prices rise, they usually stay there. Food, housing, insurance, healthcare, these costs reset higher and stick. So even if inflation is under control, your cost of living isn't. That gap between income growth and permanent price levels is what quietly drains wallets year after year. Employment data often looks strong until it doesn't. Historically, job markets react late. Companies don't fire early. They freeze hiring, cut bonuses, reduce hours. By the time layoffs show up in headlines, the slowdown is already deep. In both the US and UK, productivity growth is weak, meaning companies are paying more without getting more output. That pressure eventually forces adjustments. Not sudden, gradual, and painful. In past crises, governments stepped in aggressively. But 2026 is different. High debt limits spending. Political divisions slow decisions. Inflation risk restricts stimulus. According to IMF warnings, many advanced economies now have less fiscal space than before 2008 or 2020. So if a slowdown turns into stress, support may arrive late or smaller than expected. That uncertainty hits households first. This crisis doesn't hit everyone equally. Middle-income earners feel it most. Too much income to qualify for help, too little to absorb shocks. Heavily exposed to housing, debt, and living costs. Asset holders adjust. Corporations adapt. Lower income groups receive targeted relief. The middle gets squeezed, quietly. This is why it feels personal, even when the economy looks fine. This isn't about panic. It's about awareness. The coming pressure isn't a crash headline. It's slower growth, tighter budgets, and reduced flexibility. Understanding this early allows people to reduce vulnerability, avoid over-leverage, make smarter long-term decisions. Those who prepare quietly do better than those who react late. The next economic shock may not look dramatic. No sirens, no sudden collapse, just a steady squeeze that most people don't see coming. The hidden crisis isn't loud, but it's real. If you want clear, fact-based explanations of global finance, without hype or misinformation, subscribe to Economic Global Brief, because what's quiet often matters most.